This is going to be the most important video you'll ever watch about the stock market. And actually not just about the stock market, but about your money, your financial future, and really your life in general. You're going to be very glad that you watched this video. And to be honest, it's not going to be a very popular video because most people won't want to do what we're going to talk about. It's just not the popular thing to do, and the YouTube algorithm isn't going to promote this video, so sadly, most people aren't going to see it. But I'm still making this video because this is a very important message that anyone invested in the stock market needs to hear. Especially if you have your life savings and retirement in stocks, which most of us do. And I know markets are pretty much turned into a circus nowadays with guys on Robinhood with $20 in their account, flipping it into $60 and then calling themselves geniuses. They're playing with pennies and they think they're smart. It's all just so dumb. This video is not for those people. This message is for people who are serious about investing and growing their wealth. It's for those people who put years of their hard-earned money and savings into the market. I'm trying to talk to real investors here who want to grow their money just like everyone else, but they also have something to lose and they know this isn't a game. And what we're going to go over is exactly what the professionals on Wall Street do, and it's what makes them successful, but they never talk about it publicly. And the reason why is because no one wants to hear it. It's not popular. It's not exciting. It doesn't make headlines, and they're not about to put you on TV for it. But this is the real thing that you need for long-term success in the stock market versus what everyone else wants. So I'm sorry this isn't a video on how to 10x your money overnight, which seems to be the general consensus of how the stock market works nowadays, which is absolutely not true. And again, we all know how crazy the market has become with social media. More people than ever are getting involved and it's become a frenzy. Every day you see people on Reddit, Twitter, YouTube bragging how they double their money overnight. So easy. And the FOMO, the fear of missing out, is just rampant. But what's the deal here? I mean, you and I know that the stock market isn't easy, because if it was, everyone would be a trillionaire right now. You and I know that the reality is that most people actually lose in the stock market. 99% of people who try to trade fail. And even outside of trading, just normal investors, even people that just have a 401k, you know they get decimated and lose their life savings in the stock market as well. So what gives then? Have the markets all of a sudden changed? Of course not. Markets never change because people never change. Markets are created by people buying and selling, and you know what people are? They're emotional and dumb. Me included, I'm not outside of that. I just have ways to manage it, which we'll talk about in a second. But another big problem with all the people in the market is that they have a very short-term memory. So right now you see people bragging about putting their life savings into some meme penny stock and it tripling overnight. Wow, amazing. And yeah, it is amazing when it works, and it's real tempting to do the same thing. But if you're a little skeptical of what these guys are doing, you are right to be so, because it is all BS. Like I said, all these people have a very short-term memory, or a lot of them have just gotten into the market, so they don't have any memory. What I'm saying is that all these people forgot what it's like to be in a market that isn't going straight up, to not be in this bull market bubble. Because sure, this high risk bet it all on red strategy that a lot of people are using nowadays, it may work in the short term for a very specific type of market environment like the one we're in now. But it's asking to blow up as soon as the market turns, because markets do go through different cycles. And the problem is when it turns, those people not only lose all those gains that they got, but they lose more than that. They lose their initial capital. They blow out completely, because the same things that you were doing to make a bunch of money are the same things that take it all away plus more. It sucks. And this won't be the first time that it happens, because it has happened constantly throughout history. Going all the way back to the Dutch tulip bubble in the 1600s. That was the first recorded bubble. And yes, tulips, the flower, the bulbs were going crazy, the prices of them. And then you can see here they collapsed. And again, this is just the first recorded bubble. But bubbles and this crazy speculation that goes along with them have existed for as long as humans have been trading with each other. Like I said, people don't change. It's the same emotions driving everything. Happens again and again, and no one learns. And you don't even need to go back to the 1600s. You could go back to 2008 or even 2000. 2000 is actually the most similar to the times we are in right now. Ask someone who traded through that 2000 mania how crazy it was, how everyone was buying anything that had .com at the end of it, which seems stupid now, right, in retrospect. And this bubble that we're in currently is going to seem stupid too. Instead of .com, it's SPACs or EVs or meme stocks, penny stocks, GameStop, whatever it is. Go ask those people in 2000 how many people they saw lose everything plus more, devastated in the popping of that bubble. What I'm saying here is that nothing has changed. There's a reason why so few people are successful in the stock market. There's a reason why so many lose. And during these times, it's easy to forget what the real key to long-term success in the stock market is. So what is that key to success? It is risk management. That's the key, and that's why I talk about it nonstop. Warren Buffett summed it up pretty well. He said his rule number one is never never lose money, and rule number 2 is don't forget rule number 1. There, if you don't believe me, at least believe him. And when I talk about risk management, I'm not saying that you shouldn't go after huge returns, because you absolutely should. But there's a big difference because you do it in a safe way. And when you do it in a smart, safe way, not only are you growing what you have, but you're protecting it too. And I know protecting your money doesn't resonate with the people who have $20 in a Robinhood account. Those guys aren't serious anyway. This protecting your money idea only resonates with people who have serious money in the market. People investing their life savings and retirement, or even with the people who are just starting out investing smaller sums of money. They understand protecting your money because they know the value of money, and they know the idea of compounding that money over time so that you could grow those life savings. And like I said, this risk management idea is the key that professionals and hedge funds already know. It's why they're so successful. They don't call themselves investment managers, they call themselves risk managers. They're always looking at the downside to protect themselves. Do they still get crazy great returns? Of course they do. But the real magic in those returns is the risk management, protecting the downside. And you already know this is very different from YOLOing all your money into one meme penny stock. And why am I so crazy when it comes to risk management? Why am I just a broken record about it? Well, that's because it was the way I was raised. My dad was a fund manager, and a very successful one. So he was always 100% focused on risk control. And on top of being that risk manager, he also happened to be Indian. So he came over to America with $7 in his pocket, which I guess is what they give to every immigrant from whatever country they're from. You come to America, you get $7 so you could tell your kids how you only had $7. It's the immigrant story. So you could imagine how he feels about money, like most immigrants do. Combine that with being the fund risk manager, well, you could only imagine the amount of lecturing I have gotten throughout my life from the time I could understand words. Me and my little brother. My little brother was 4 years old telling people to cut their losses. Did he know what it meant? Of course not, but he could say it. And on top of being brainwashed into risk control my entire life, I also co-founded MacroOps, a global macro research and consulting firm. And our shop caters to professionals. So hedge funds, sovereign wealth funds, prop firms, all the big boys, the people managing billions of dollars. And we actually all have a Slack channel where we chat each day. And we're on the phone with these guys too. And the number one topic is always risk management. Because again, it's the key. It's not necessarily fun, like making 10x in something overnight, but it's what lets you grow your money and keep it too. So how exactly do you manage your risk? Well, the key is to have an investment strategy or system. You really need that. So I could show you how we do it with our Fallible strategy. So our Fallible strategy right here is a momentum-based strategy. So the idea is find the stocks with the highest momentum and ride them higher. So we have something called a TSI scanner right here that ranks all the stocks in the NASDAQ by their momentum. It spits out a little number right here. And with our strategy, we rotate into the top 5 highest momentum stocks each month. The idea being, if you're in a stock with high momentum, it should go higher the fastest, right? And that's exactly what happens. That's how we make returns. And it's great because it's a full system that knows the entry points, the exit points, everything. And we just get alerts to our phone, myself and all our Fallible members, every time we need to buy or sell anything, because it's all based off a strict model. And you can see right here, the returns are awesome. Since 2008, we have almost 2,500% versus under 700% from the NASDAQ itself. You can look at the equity curves right here. This blue line is our strategy versus the red line, which is the rest of the market. Huge difference, not even a comparison really. But the real key here, why these curves are so different, it's not just because of our momentum strategy and our algorithm and all that. The real key is the risk management. One of the most important things you could do when you're investing is cut off tail risk. And what do I mean by tail risk? I mean those once in a lifetime moments where the market just collapses, which I say once in a lifetime in quotation marks because it's not once in a lifetime. It happens more often than we would like. I'm talking about those huge dislocations, 2000, 2008. They're becoming more and more frequent now too. So that's what we call a tail risk. And if you could cut that off, your returns are going to be so much better. And how do you cut it off? With risk management. I can show you right here how our strategy did in 2008. Horrible year, right? We were only down 7.2%. And you can see the market here in general was down way more than that. But let me just show you how the numbers shake out when you're able to reduce your losses like that. So say you got $100,000, right? And you go through the entire market crash without managing your risk. So say you go down 42%. That means you lost $42,000. You end up with $58,000. Now tell me, percentage-wise, what do you need to make to get back to 100,000? Is it just 42% because that's what you lost? No, of course not, because that's not how math works. If you start with 58,000 and you want to go back to 100,000, you're going to need to make $42,000 on that 58, which is a 72% return. That's how you get back to 100%. So if you take a 42% loss, you need a 72% return to get back to break even. That is rough. A 72% return is great in the market, not easy to come by. That's why a much easier strategy is just to avoid that crash in the first place. So with our strategy, say you have $100,000, our drawdown, like I showed you, was 7%. This was in 2008, right? So $7,000. That leaves you at $93,000. So if you have $93,000, how much of a percentage gain do you need to get back to break even? 7.5%. That's it. And you'll find yourself back at break even. So compare a 7.5% gain versus a 72% gain. Which is easier? Obviously the one where you manage your risk. And I can show you a more recent example right here. This whole 2020 March crash. Market dropped a nice chunk. Not as bad as 2008 or 2000, but not good. And here is our Fallible Strategies equity curve during that time. You can see this blue line is the market collapsing, where this green line is our strategy that stayed pretty much flat. So when the market recovers, what happens? Well, people who didn't manage their risk are down 20% and have to make that up. Where us using the Fallible strategy, or anyone controlling their risk, we're starting up here. So when our gains come in, they're coming in from up here. So we're already up 20% when the market is only up 0, break even. And if you manage your risk and sidestep these tail events over and over again, you can see why these equity curves are so different over time. You absolutely crush the market. Now on a year-to-year basis, you could see here that we beat the market a lot, but you compound that over time and you avoid those huge drawdowns, oh man, the difference is just huge. I mean, you see it right here. And again, that is the power of risk management. That's what the professionals know. Manage your risk and your upside is just going to be so much better than everyone else's. And my favorite thing is that this risk management doesn't have to be hard. That's why I said the key is a strategy or a system. Our Fallible system literally takes 15 minutes a week, even less than that. I barely have to look at the market. And that's really important. I'm not just bragging here, because you do not want to be glued to your screen all day. It's bad for your mental health and your wallet, because when you're looking at price fluctuations all day, you start doing stupid stuff, making stupid trades. You don't want that. You want to stay away from the screen. And myself and a lot of our Fallible people using this strategy, we're business owners or we have full-time jobs. So we don't have time to be researching the market all day, but we obviously still want returns with our downside protected. And that's what you could get with the system. Now, if you want to learn more about our Fallible strategy in particular and how it manages risk in more detail, so you could do it yourself, then definitely check out our free training that goes over step by step exactly how it's done. I mean, you know, we already talked about it a bit in this video, but this is way more in detail. I'm going to put a link to this training in this video and down below in the description and comments. And like I said, this is the same strategy I use and all our Fallible members use, and we're all very, very happy because we're all real obsessed with risk control and we see how it pays off. So again, if you want to learn how the strategy works so you could use it yourself, just click this link right here to go to that free training. It's going to teach you everything you need to know to grow and protect your money to have that long-term success in the stock market. So click this link right here and I will see you in that training.